Welcome to Financial Basics course. This course is designed to introduce the most fundamental concepts, instruments, and institutions of finance. Its purpose is to ensure that all students share a common vocabulary and conceptual understanding before beginning any upper-level finance coursework. Finance builds cumulatively. Concepts such as stocks, bonds, markets, exchanges, and financial instruments are assumed knowledge in virtually every finance course. This course is therefore a prerequisite study. Students are expected to read, learn, and understand these basic financial concepts before progressing to more advanced topics in finance, investments, corporate finance, or financial management. The focus of this course is not on strategy, modeling, or advanced analysis. Instead, it concentrates on clear definitions, basic mechanics, and economic intuition. We emphasize what financial instruments are, why they exist, and how they function in the simplest possible terms. Real-world examples are used only to illustrate concepts, not to teach trading or investment techniques. Throughout the course, you will learn the foundational building blocks of finance, including stocks, bonds, markets, exchanges, brokerage firms, basic trading orders, and elementary risk concepts. Mastery of this material is essential, as these ideas will be taken for granted in all subsequent finance courses. This course is organized as a sequence of short, focused lectures. Each lecture addresses one basic concept that every finance student must understand. Together, these lectures provide the conceptual groundwork upon which all future finance learning is built. Let's quickly talk about the topics and the concepts covered in each lecture. Lecture 1 is What is a stock? It introduces stocks as ownership claims in a company. We cover common, preferred, and classified stock, shareholder rights, dividends, voting, boards of directors, and the distinction between shareholders and stakeholders. We talk about real-world examples such as Apple, Alphabet, and activist investors illustrate how ownership works in practice. Lecture 2 is What is a bond? It explains bonds as debt instruments. We cover key bond terminology, including coupon, face value, maturity, and yield, and introduces treasury, corporate, municipal, and convertible bonds. We emphasize differences between bonds and stocks in risk, return, and legal priority. Lecture 3 is Fixed Income Securities. It expands on bonds to cover certificates of deposit, treasury securities, agency bonds, municipal bonds, mortgage-backed securities, asset-backed securities, money market funds, and preferred stock. We highlight the stabilizing role of fixed income in portfolios. Lecture 4 is Exchange-Traded Products. It introduces pooled investment vehicles such as mutual fund, ETF, ETN, ETC, REIT, and trust. We compare structure, liquidity, risk, and cost, and explain their importance in modern investing. Lecture 5 is What are derivative products? It explains derivatives as instruments whose value depends on underlying assets. We cover forwards, futures, swaps, and options, with applications in hedging, speculation, and risk management, including commodity and currency examples. Lecture 6 is Investing, Trading, Speculating, and Hedging. It explains the key differences between investing, trading, speculating, hedging, and gambling, terms that are often confused but represent very different financial activities. We examine each concept's goals, time horizons, risk profiles, and typical strategies using real-world examples from stocks, bonds, derivatives, and futures markets. Lecture 7 is Dividend and Coupon Payments. It focuses on how investors receive cash flows. We compare dividends and coupon payments, examine dividend policy theories, and discuss implications for valuation, taxation, and investor behavior. Lecture 8 is What is a Homemade Dividend? It introduces homemade dividends and the Modigliani dividend irrelevance proposition. We explain how investors can create their own cash flows and the implications for corporate payout policy. Lecture 9 is What is a stock split? It explains stock splits and reverse splits, why firms use them, and why splits do not change firm value despite market reactions. Lecture 10 is What is short selling? It introduces short selling as a strategy that profits from declining prices. We cover mechanics, margin requirements, unlimited loss potential, and real-world examples such as short squeezes. Lecture 11 is Exchange, Market, and Index. It clarifies key market terminology. We explain the differences between exchanges and markets and how indexes such as the S&P 500 and Dow Jones Industrial Average are constructed and used as benchmarks. Lecture 12 is What is a stock exchange? It explains how organized exchanges such as the NYSE and NASDAQ function. We cover listing requirements, primary versus secondary markets, order matching, regulation, and global exchanges. Lecture 13 is What is a brokerage company? It examines how brokerage firms connect investors to markets. We cover full service versus discount brokers, brokerage accounts, trading apps, order routing, regulation, and investor protection. Lecture 14 is Margin and Leverage. It explains how margin and leverage amplify both gains and losses. We cover initial and maintenance margin, margin calls, forced liquidation, and the role of leverage in stocks and derivatives. Lecture 15 is What is a market order? It introduces market orders as the simplest trading instruction. We discuss execution certainty, price uncertainty, liquidity, and slippage using real trading examples. Lecture 16 is What is a limit order? It explains limit orders and contrasts them with market orders. We cover price control, execution risk, and strategic uses by traders. Lecture 17 is What is a stop-loss order? It describes stop-loss orders as risk management tools. We explain triggering mechanisms, advantages, disadvantages, and behavioral considerations in volatile markets. Lecture 18 is What is an income statement? It introduces the income statement and explains how revenues, expenses, and profits are used to evaluate a company's financial performance. We cover how to interpret key profitability measures and understand the limitations of income statements in financial analysis. Lecture 19 is What is a balance sheet? It introduces the balance sheet and explains how assets, liabilities, and shareholders' equity provide a snapshot of a company's financial position at a point in time. We cover how the balance sheet is used to assess liquidity, leverage, and overall financial health, as well as its role alongside the income statement and cash flow statement in financial analysis. Lecture 20 is What is a cash flow statement? It introduces the cash flow statement and explains how cash moves through a firm's operating, investing, and financing activities. We cover how the cash flow statement is used to assess liquidity, financial flexibility, and the sustainability of a company's operations, and how it complements the income statement and balance sheet in financial analysis. Lecture 21 is What is inflation? It explains how inflation reduces the purchasing power of money. We cover how inflation is measured, the difference between inflation and relative price changes, and the distinction between nominal and real values. In summary, Financial Basics is a foundational course intended to establish the minimum conceptual knowledge required for the study of finance. The material covered in this course is assumed knowledge in all subsequent finance classes, and students are expected to fully understand these concepts before moving on to more advanced coursework. A solid grasp of these fundamentals will make future finance courses more accessible, more rigorous, and ultimately more rewarding. I look forward to an insightful and productive term with you all. Thank you for taking this course. See you in class.